When AI-driven equities, sticky inflation, and record FX carry trades all move together, cross-asset risk can change very quickly. Welcome to vTalkInsight, Allocator's Lens Daily for July 13th, 2026. We're going to connect the dots across equities, rates, credit, currencies, and commodities so you can see where the balance of risks and potential resilience is shifting right now. In equities, the central tension is an AI-driven boom that still underpins index strength, even as signals of overextension and fragility multiply. Headline indices in the United States have continued to grind higher with volatility in the mid-teens, yet beneath the surface, gains are narrow, valuations are at multi-decade highs, and a handful of megacap and AI-related names are doing most of the work. Semiconductors sit at the heart of this story. Sector earnings have more than doubled year-on-year, and expectations call for similarly strong growth again, helped by surging demand for high-bandwidth memory and AI data center hardware. SK Hynix is emblematic. Its United States listing was multiple times oversubscribed. The shares opened sharply above issue price, and passive inflows are expected as it joins major indices, while new leverage products targeting AI and memory exposure add another layer of speculative activity. At the same time, semiconductor indices are up close to triple digits from their lows. Technical indicators flag them as overbought, and daily moves of 2 to 4% have become common. Some technicians now see scope for a further 20 to 25% downside if the current parabolic pattern breaks. And there are growing worries about overbuild in data center capacity, intense competition, and a scale of tech malinvestment that some estimate could dwarf prior bubbles. Broader United States equity markets are feeling the effects of this concentration. Outside the largest AI leaders, earnings look much weaker, even though overall profits have significantly beaten expectations in recent quarters. Consensus is now looking for profit growth of more than 20% year-on-year, which raises the bar for the upcoming reporting season, especially for the big banks and major AI spenders reporting around next Tuesday's inflation data and Federal Reserve speech. Meanwhile, the rise of single-stock and leveraged exchange-traded funds has amplified upside moves, but could equally magnify any downside, and despite low option costs, relatively few investors are hedging, potentially leaving the market more exposed to shocks. The good news for equity allocators is that leadership is slowly broadening. Small caps have outpaced the S&P over the past 2 years, with recent leadership shifting toward higher quality, profitable names within the Russell Index. European equities are seeing a more diversified earnings recovery, with roughly 40% of the MSCI Europe universe linked to AI capex, but many non-AI compounders also delivering upgrades, and sectors like banks and industrials benefiting from moderate inflation and offering a potential diversification away from United States tech concentration. Travel and airlines add another dimension. Delta has just delivered stronger than expected earnings, reaffirmed guidance, and maintains solid margins despite record fuel costs, helped by premium and corporate travel and by growing profits from its credit card partnership. In Europe, a bidding war around EasyJet has pushed its shares sharply higher and highlighted renewed private equity interest in profitable network carriers. Looking ahead, the combination of elevated earnings expectations, concentrated AI leadership, semiconductor volatility, thinner summer liquidity, and the upcoming cluster of bank earnings and inflation data creates a fragile backdrop for equities, which ties directly into the rates story. In rates, the picture is dominated by persistent inflation colliding with an already significant repricing higher in yields. Price pressures remain stubborn across both manufacturing and services, with recent surveys showing elevated prices paid, upside surprises in core components like technology, healthcare, and entertainment, and an uptick in wage growth back above 4%, according to one prominent tracker. Health insurance costs are projected to post double-digit increases into 2027, and AI-related capital expenditure is driving higher input prices for chips, power, water, and other infrastructure. Despite this, policy is not obviously restrictive. Nominal GDP growth is estimated in the mid-single digits, while the policy rate is still materially lower, implying that monetary conditions are, on some measures, stimulative and may be contributing to ongoing inflation. The Federal Reserve has seen inflation-adjusted 2-year yields rise by roughly 175 basis points from their lows this year, and Treasury yields have moved higher across the curve, Yet unemployment claims are down on a year ago, and there is little evidence so far of broad labor market weakness. Against this backdrop, the central bank reaction function is evolving. Officials are placing less weight on each monthly inflation print and more on the multi-year pattern of above-target inflation, while acknowledging that prices may now be less sensitive to interest rates alone. New policy task forces that bring in private sector data and AI expertise and a renewed focus on balance sheet design could eventually increase central bank credibility, but also add uncertainty for markets as the toolkit changes. Globally, Japanese policy has become a swing factor, with government encouragement for pension funds to invest more at home triggering sharp moves in Japanese government bonds and raising questions about future demand for overseas sovereign debt, including United States treasuries. Market structure is another concern, as a growing share of treasury paper is held by hedge funds running basis trades, which may increase sensitivity to bouts of risk aversion. With yields already higher and inflation still sticky, bonds have offered less diversification against equity risk than in the past. Next Tuesday's combination of consumer and producer price data, major bank earnings, and a speech from the Fed chair is therefore a key near-term catalyst for the rates complex and for cross-asset volatility, and it will feed directly into credit conditions. Credit markets remain remarkably calm given this rates backdrop. Investment-grade spreads are unusually tight despite heavy issuance, and high-yield spreads around the mid-200s, alongside subdued bond volatility, signal limited concern about near-term default risk. The composition of high yield has improved, with a larger share of higher-rated borrowers and extended maturities, and many lower-rated companies have been able to refinance at manageable costs while the window is open. However, the demand for capital is climbing fast, especially in AI-linked sectors such as data centers and chip manufacturing. Large data center operators have roughly doubled their debt over the past 5 years, and new bond deals tied to AI infrastructure increasingly feature project finance structures and secured tranches that require more granular analysis. There are signs of investor fatigue with AI-themed issuance, with recent jumbo deals attracting less incremental interest than similar transactions just a few months ago. As a result, credit risk is shifting from macro recession worries toward capital structure vulnerabilities. Highly leveraged borrowers from the 2020 to 2021 period, especially those now ramping AI or cloud spending, may find refinancing more challenging if yields stay elevated. One large technology and software name has already been downgraded to the lowest investment grade notch due to heavy AI infrastructure spending, and concerns are building that a further downgrade could ripple through parts of the United States credit market. Japanese investors keeping more capital at home as domestic yields rise could also reduce an important marginal buyer for foreign credit, particularly in Europe and some emerging markets. For allocators, the key signals now lie in how spreads behave around upcoming waves of issuance, especially from AI-intensive and lower-quality borrowers, and in whether any single-name events start to challenge the current perception that credit risk is contained. Those dynamics also matter greatly for FX markets, where carry trades are flourishing on the assumption that volatility and credit stress remain subdued. Foreign exchange is currently defined by the return of powerful carry trades. According to one major dealer, conditions for G10 carry are the most attractive in over 20 years, with strategies funding in low-yielding currencies like the yen, Swiss franc, and euro delivering roughly 8% gains year-to-date, outpacing global bonds, gold, and even Bitcoin. This reflects both high short-term interest rate differentials and unusually low currency volatility. The yen is central here. The Bank of Japan is expected to move cautiously on rate increases to support domestic growth, which keeps the yield gap with other economies wide, even as authorities occasionally intervene to lean against excessive weakness. Japan's push for pension funds to invest more domestically has helped the yen off extreme lows, but is also reshaping global bond flows. In Korea, by contrast, the won remains under pressure from portfolio outflows and bouts of risk-off sentiment, despite equity strength, and policymakers may need both intervention and potential rate hikes to stabilize the currency. All of this is playing out against a backdrop where, despite talk of declining dollar demand, appetite for United States assets remains strong thanks to higher yields and relatively better growth. The combination of a firm dollar and profitable carry trades underscores a broadly risk-on environment, but it is also a potential point of fragility. A sudden repricing in rates, credit, or commodities could force a rapid unwind of leveraged FX positions. Energy markets, particularly oil, are one obvious candidate for such a trigger. In commodities, oil sits at the intersection of geopolitics, growth, and the AI theme. Tensions around the Strait of Hormuz and the risk of United States military strikes against Iranian targets keep an embedded risk premium in the physical supply chain, and markets are watching closely the volume of tankers able to transit safely. Yet record crude output from the United Arab Emirates, which is now operating outside OPEC constraints, together with aggressive price discount from Saudi Arabia, has pushed benchmark prices lower and left crude trading in a relatively tight range. Beneath that calm, product markets are much tighter. Diesel crack spreads have surged on the back of Russian strikes on refineries and reduced refining capacity, particularly in Europe, while China has relaxed refined product export quotas in a way that could lift its crude import needs and tighten global balances if targets are met. Several observers point to a growing gap between subdued financial oil prices and increasingly constrained physical markets, which could mean that current valuations underestimate upside risk for energy-exposed assets. The energy story now extends directly into electricity, especially in the United States. After a decade of flat demand, data center growth tied to AI has created unprecedented strain on power infrastructure, turning grid connection times into a bottleneck and prompting many operators to invest in on-site, off-grid generation. In unregulated markets, this is already driving higher regional power prices as data center operators bid aggressively for scarce capacity, which in turn feeds back into inflation pressures and the cost structure of the AI ecosystem. How the next set of oil market reports, shipping flows through Hormuz, and regional power prices evolve will be critical for the broader macro narrative. Pulling it together, the cross-asset picture today is one where equities are priced for a powerful and sustained AI and earnings cycle. Even as semiconductors flash late-stage signals and valuations across major indices sit at multi-decade highs. Rates markets are shifting toward a higher-for-longer regime, with sticky inflation, rising real yields, and evolving central bank frameworks that lean more on balance sheet tools and richer data. Credit still looks benign on the surface with tight spreads and improved quality, but the growing weight of AI-related capital spending, more complex structures, and idiosyncratic stories in highly leveraged names suggest that balance sheet risk is quietly building. FX carry trades and a resilient dollar highlight how much the search for yield depends on low volatility and stable funding markets. While in commodities, the combination of geopolitical risk, tight diesel and power markets, and range-bound crude prices could be underpricing future inflation impulses. For allocators, the key watch points now are the upcoming cluster of inflation data, bank earnings and Federal Reserve communication, semiconductor and credit market behavior around AI-related names, the durability of FX carry, and any sign that physical energy tightness starts to spill decisively into prices. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.